You are fully invested right now. You would say I'm not, but the data says you are, because the institutions that manage your pension, your 401k, your retirement, they just dropped their cash to 3.9%. That is a level so low, Bank of America calls it a formal sell signal. But that is not the part that concerns me. What concerns me is what I'm about to show you over the next few minutes. Record leverage, rate hike that most investors are even not discussing, and the largest foreign buyer of US debt turning into a seller, and retail speculation that just surpassed January 2021 levels. So every single one of these is flashing right now at the same time. Hey, my name is George. I spent over a decade on the institutional side, and currently I'm investing my own money. And what I do here is very simple. I show you the same data the institutions are using, the same data that I'm using myself, so you stop being the exit liquidity and make better financial decisions. The headlines say the S&P 500 is at all-time highs, and that is not wrong, but here is what they are not showing you. This is Bank of America chart, S&P 500 net margins versus everything X Max 7 and Tech, going back all the way to 2002. Look at the yellow circle. The index record margins, strip out 7 names, and margins are rolling over, so they are diverging. And the bread confirms it. Only 27% of S&P 500 stocks are outperforming the index. A z-score of negative 2.8, first percentile, and the worst bread in 30 years of data. So when someone tells you the market is at all-time highs, ask them which market exactly, because 7 stocks are, the other 493 are not. Think of it like a swimming pool. The total volume of water hasn't changed, but all the water just sloshed from the shallow end into the deep end. So if you are standing in the deep end with those 7 stocks, it feels like a boom. But if you are anywhere else, you are standing on a dry concrete. And psychologically, this is the trap. You see the index climbing and it feels like you are missing out. And that is exactly how it felt in late 2019 and 2021. The broad market was already deteriorating underneath, but the index masked it. If you have been feeling like the market narrative doesn't match what you see in your own portfolio, please share that in the comments. I read everything that you're writing. But here is what changed in the last 30 days. The first driver is oil. Crude above $100 feeds directly into producer prices. Producer prices feed into CPI, so if CPI stays elevated, the thesis suggests the Fed has no room to cut. So if the Fed cannot cut, the long end of the curve reprices higher. And right now, 30-year bond yields across the US, UK, France, and Japan are all at their highest levels in decades. So when rates increase, that leads to demand destruction, and if borrowing costs more, people buy less and demand destruction leads to deflation eventually, which is the biggest threat to the US economy and the S&P 500. So we are getting to the part that I was warning that Japan will eventually do, and it is what they are doing to your treasury bonds right now. And they have just dumped $29.6 billion in a single quarter, the largest sell-off since 2022. They have a yen problem at home. USD JPY is pushing 160, and their own 10-year yield just hit levels not seen since 1997. So they're pulling capital home to defend their own currency. Imagine you are selling your house and the guy who usually buys every house on the block suddenly decides he needs to sell his own stuff instead. Who buys your house? You have to lower the price to find a new buyer. In the bond market, lowering the price means raising the yield. That is a structural shift in demand for US debt. And as you know, we have a big problem in the United States. And this does not just hit your portfolio. If yields keep climbing because the largest buyer is now a seller, your mortgage rate goes up, your car payment goes up, your credit card rate goes up. The cost of everything financed on a variable rate debt just got more expensive. And the Fed knows this, but they cannot do anything about it because they cannot cut rates because oil is at 100 and they cannot stimulate the economy because leverage is at record highs. And now let's talk about leverage. I showed you this in the previous video, but with this latest data from Bank of America, it is even worse. FINRA margin debt relative to GDP, 4.09%. Look at the chart. This has never happened, not in the dot-com bubble, not before 2008. Never. This is like a game of musical chairs where the music is still playing, but there are only 3 chairs left and everyone in the room is holding a glass of nitroglycerin. And a margin call at this scale does not just hit stocks, it hits everything. And who is on the other side of this? Retail. Citadel Securities just confirmed May 2026 is on track to be the most active retail trading month in history. Cash volumes 12% above January 2021. Options activity 60% above the historical average. The data suggests retail is concentrated in call options on AI and semiconductor names, not hedging. So retail currently does not hold any hedges if we see a market correction. The institutions that manage your pension funds do not buy and hold, they rebalance, rotate and hedge always. And they're nothing like retail. If this is changing how you think about your portfolio, please write what's your current strategy right now. I would love to hear that, and also I read everything that you're writing in the comments. Now the bull case, and I want to be completely fair. The strongest argument right now is that the AI earnings are real. Hyperscaler capex is accelerating, and the thesis suggests that if AI productivity gains filter into the broader economy, the margin compression for the other 493 could reverse. However, if oil stays above 100 and the Federal Reserve is forced to hike even once, this entire framework has serious problems because the record margin debt we just saw gets repriced overnight and margin calls do not care about AI narratives. So here is what I am doing. As an investor, I want to deploy capital, so don't get me wrong about this one. But right now I'm being strategic and I'm being very cautious. I am keeping my dry powder because of what I have showed you so far. So I'm waiting and I'm watching. The opportunity will come soon for us to make some wealth, but it is not right now. And that is why waiting is the key. So you deserve the same information the institutions are using. The only difference is who shows it to you. See you in the next one.